Calling to order Silicon Valley Clean Energy Finance and Administrative Committee meeting of May 28th to order at 10:04. Can we have roll call, please?
Yes. Chair Srinivasan.
Present.
Vice Chair Mekachuk.
Present.
Director Hines.
Present.
Alternate Director Risto.
Present.
Thank you. We currently have a form of our committee present.
Thank you. So I'll open for public comment on matters not listed on the agenda. Public may provide comments on any matter not listed on the agenda, provided that within the subject matter jurisdiction of SVCE. Speakers are customarily limited to 3 minutes. Do we have any speakers in person or online? We close public meeting, public comment, and then bring it back to the committee for consent calendar. Do we have any questions or comment on consent calendar from the committee members? If not, I'll open for public comment on consent calendar. Do we have any persons wishing to speak on consent calendar? Remote
No hands raised for this item, Chair.
With that, we'll close public comment and then have a voice vote.
I'll make a comment, and I'll just say that on 1B, this is part of our decision a while ago to have all the certain policies pushed to the staff level, and then we approve them because our charter says we have to approve them.
No, so what we did was, and I'll let Mike speak to this as well. So we cleaned up a bunch of policies and we streamlined the number of policies that got approved by board, and then we moved some policies into what we call standards, and those were approved at the staff level by me. And so, but also included within the revisions of the policy was a commitment to bring on a regular basis updates to the policies as we saw fit, either because our business practice changed or we found some things that just weren't clear. And so what 1B is it's the review of certain finance and admin committee related policies that we reviewed from last year that got approved. And so there's some minor changes on some of them. And then I think if in terms of the substantive change, Mike, if you want to speak to any substantive changes that exist within 1B, feel free to do that.
Thank you. Yeah, and they were described in the staff report that I believe was included with the packet, but there's a number of changes with the purchasing and spending policy, some sort of minor things consolidating energy related authority in the energy risk management policy and standard and not keeping it in the purchasing and spending policy, which is more related to sort of standard vendors, not the sort of big scale energy contracts that we do. We have clarification that the board delegates authority for staff to enter into grants and scholarship agreements associated with board approved programs. We typically get that authority when we're getting the program approved, but this is just to catch any that where we didn't get that authority. Clarify that we can apply for external grants without seeking board approval. Sometimes those come with strings attached, matching funding, staff time, those type of things. We haven't really gone after many of those. We've done some, supported grants that other entities have gotten, but that's in there as well. And we discussed this also includes delegating authority to the CEO to enter into settlement agreements to accept up to $250,000 of a payment without going to the board for approval. And really, this is intended to cover more minor commercial disputes where we need a resolution and to kind of limit the things that the board needs to approve. Recently, we had a power purchase agreement where some of the energy we got was supposed to be renewable, but it was disqualified from the California Energy Commission. And so we worked out a settlement dollar amount with the counterparty. It didn't impair our clean goals or targets. It's sort of minor and on the edges. But, the board may not need to look at those things. And so we're proposing, again, up to $250,000 of settlement agreements that's delegated to the CEO. We direct that some energy solicitation rules go into the energy risk management standards. There's otherwise vendor solicitation rules in the purchasing standard today, and it's a little apples and oranges between the two sides of the business. And then we clarify emergency procurement rules there and clarify that the CFO can delegate their authority to approve wire transfers, which has to happen sometimes when the CFO is out. And so it's really, again, just for the purchasing and spending, that's where the biggest changes are. Those are intended to sort of enhance aspects of the policy, make it more complete, clarify delegations to the CEO, and reduce sort of the administrative churn of things that have to be brought to the board. And then the investment policy has a change where we are moving away from managing diversification by both financial institution and security type to sort of just focus on the security type. And financial institution was sort of a fuzzy word, and so we're revising that to be sort of the issuer focused, because a financial institution could arguably be our financial advisor, and there's no real concentration risk, with them advising us across the suite of our investments. So sort of a technical update there, but just intended to kind of capture reality. And then there's some other kind of modest cleanup, title changes, things like that, to an IT policy, a purchasing card policy, and a delinquent accounts and collections policy. So that's the overview of what the changes are.
Great, thank you for that. I think it's really helpful to understand that and have you explain it in person. So appreciate that.
Thank you. Any other comments or questions? In that case, can we have a motion?
I'll make a motion to approve the consent calendar items 1A and 1B.
Second. Can we have roll call, voice vote, please?
Sure. All in favor?
Aye.
Any opposed? Abstain? That carries unanimously.
Thank you. Next is the regular calendar, CFO update. Generally you sit here.
But I have a clear shot of the screen. I actually don't have any items, but I first of all welcome to the committee members. But if you have any questions, I'd be happy to take them. A lot of what I would have covered are actually will be in the agenda items. So if you have no questions.
Any questions on?
Just making sure that, Chair.
No, go ahead.
Just making sure it'll be part of the discussion at some point. Just the sustainability of the reserves usage for normal operating procedures. Is that going to be part of your other discussion?
It will come up in the stress test analysis,
Great.
And then
I thought so.
And also obviously when we do the budget.
Okay. All right. Thank you.
That we'll close that item and move on to item 3, results of stress test analysis.
Scott, presenting to Director of Risk Management and Analytics.
Hi, everybody. I'm going to move through this briskly so that we have more time for discussion than listening to me talk. So I might skip over some slides or just touch on them, and feel free to flag it if you'd like me to dwell on something. So every year we do stress testing as a way to understand our exposure to a variety of things, but the biggest one is just market prices overall. So we're going to discuss that today. But let's start moving through the slides. We can just go to the next one and the next one. So this is just a quick reminder of the process. So all of the staff contribute to what we call our risk register. They identify risk and score the magnitude and the likelihood of that risk impacting us adversely. Some are easier to quantify than others, but they're all involved in that process. They get scored and ranked, and we see what filters up. And then we model scenarios on some of the strongest ones, or we make sure that you're aware of what some of those strongest ones are. Okay, the next slide. We're going to talk about this probably more and more places, but this is just a reminder that based on a business as usual, how we set rates, our our revenues are closely tied to what the PG&E generation and PCIA rates are. And when market prices go up, that what we call headroom or available revenue for the agency increases. When prices go down, it tightens for us. Next slide. This is a similar story, so we'll keep moving. Okay, so the base case that we used for the stress testing is slightly different than what you would have seen last as part of the mid-year budget. So all we're doing here is just calibrating you from mid-year budget to our stress test base case, so you have some bridge there before I move into the stress cases. So really just going to show you the reserves. So Andrea, if you could jump to the slide with the bar charts. This is the first one, perfect. So the gray bars represent what we presented at the mid-year budget as the reserves on a forecast out. And these would be generally aligned with the levers discussion that was also part of the last several months. When we update the base case, a few things happen. A couple things I want to call out. I want you to look at first at calendar fiscal year 2030. So one thing we did here is we shifted to the new calendar fiscal year from the old fiscal year. So that's one minor change that might not be obvious. In that end of year would have been in the mid-year budget forecast out 5 years. That would have been 122 days cash on hand at the end of that under a business as usual forecast. We now get 188. So some things have changed, market prices, portfolio position, and so forth. The early year that shows 614, that's because rates are fixed and market prices have come down. So the rates aren't moving in the current year with market prices. That true up happens the next year, which is why the second year is not so different between the two. Okay. And in the last year, we did not forecast at the mid-year budget 0 for 2031. We just didn't have a forecast for that year. So we're showing you 2031 because we now go out that far. But this is just giving you that context. This is just a reference for you to understand mid-year to base case for the stress testing. All right, let's probably jump ahead several slides. There's assumptions and disclaimers that we've put in here that I'm happy to touch on if you've reviewed the materials or read the staff report or do. We can keep moving. So let's jump to the next slide. Okay, so I'm not going to go through every bullet here, but the basic gist of this is in the past, we said, here's market prices and there's a stress world where these prices drop. Well, guess what? We're experiencing close to that stress world that we've told you of in the past. However, that does not mean that this current world that we're in is the floor, right? It's kind of, if you think about it as like a stock forecast, if I forecasted that Apple stock might drop to $150, once I get to 150, it could still go lower, even though in the past I might not have had that as a stress in that scenario, right? So as we move through time, we're updating these things. It is not uncommon for prices to move volatilely in the power market. So we're not shocked by it, but we have to appreciate that it can happen. So if we keep moving, this is just historic data to show you that dramatic changes have happened. This is stress from the 2008 economic crisis. This is on natural gas. We can keep moving down several slides, I think. Okay, so this one is just showing you what has happened since 2023 for the 3 major commodities that go into the stress testing. One is power prices, one is renewable RPS standard PCC1 credits, and the third one is resource adequacy prices. So you can see they've all gone down. It's not that they're not going below levels that we would otherwise think are absurd or not normal, because if you look in the past, they have been low. So coming down is not shocking, but it's also concerning for our business approach. We keep moving. You can keep moving past this. And you can keep going. Okay, so before we get into the final analysis results on the quantitative stress testing, I want to touch on a couple things. One is we did an additional stress on our stress case. So we have a second stress case, if you will, that accounts for the risk of having stranded assets because of the CPUC procurement order. So if they require us to buy the assets ahead of time for the future, but then the loads don't show up in the future, there's a risk that market prices follow that depressed format, and we would have paid a high price as we view in the market today from the offers we get compared to the value of those resources if the supply and demand is out of balance in the future. So this scenario, I'll show you a minor adjustment to what could be if we have those additional assets in the portfolio. They've not been procured yet. So, and then the next two slides are more of an attention raise. I'm just going to spend a moment on them. These aren't quantified. Too much uncertainty, too difficult to quantify, but things you should understand. For the agency, affordability is a potential stress if the economic and political pressures would kind of light on our rates heavily, and we would have to decide how to address it. It's a little bit nuanced, obviously, but it's just something that you should be aware of. And the next slide just touches on the PCIA, and there's a lot going on, and there's a lot of uncertainty, and a lot of these things can change with the decision of the CPUC commissioners. And so we're monitoring that. On both of these items, our staff is mitigating by being involved in activities related to working with CalCCA and directly with regulators and legislators. All right, so let's move into the results on the quantitative piece. So keep moving through. All right, so this slide is showing you now in blue is the revised base case, so that stays the same. And the orange is an unmitigated, basically all the assumptions on how we function as a business stay the same, but we experience the low first percentile stress case on commodity prices. And what you see here is that we go dramatically negative, which obviously we would advise against and you would probably take action to avoid. Thus, I say unmitigated. And that's all part of the next discussion with the levers analysis. But ultimately, this is to shine a light on you that reserves are important. Holding reserves is not in our volatile environment is not something that's like keeping something to ourselves as a security blanket. It's really a need for managing the business properly. So the main takeaway from all of this that we want you to come up with is that the stress case that we have run demonstrates that there is a extreme, unlikely, but plausible scenario where we have further stress even from current levels. And then, Andre, if we could just jump briefly to the slide that has the second set here. There we go. So the green is simply to show you the initial impact of the additional resources that we would, if we bought them today or in the near future at current market prices for the future ramp up required by the procurement order from the CPUC, and prices came in low, we would add another negative hit to the business because of those resources. And in fact, this just shows you the first few years in the 29 through 31 period. Reality is those contracts would then be in place for 10 or 15 years. And that runs, in that scenario, they run about a 60 million per year stranded cost to the organization and customers. So, and then Andrea, we just want to jump to the next step slide. Recommendation. There we go. And so the three recommendations we have out of this, 2027 is expected to be our worst financial year that we've seen. We're monitoring the market developments and we're A big factor is going to be where the PCIA and gen rate actually come out at the end of this year, when proposed or recommended by PG&E to the commission for next year. And then monitoring how 5-year forward markets evolve over the balance of this year. So that's a big element to be aware of. The 27 budget will give us more certainty for next year. And then the last thing is just, we're really ultimately seeking your approval for the financial levers playbook that Justin will discuss, and implement it as necessary to mitigate this sort of outcome if it gets worse, or if we need to, we're in a persistently low price environment and need to address it. So I will stop there, said a lot, tried to say it fast, but let's maybe discuss Q&A if you have any questions, and we can jump back to any slides if you desire.
Okay, thank you. Any questions from the committee members?
Yeah.
It's that's a good comment.
I guess one question I have is, like, knowing this, how does this impact our steps going forward to acquire more energy sources?
You want to answer that, Scott? Go ahead.
Yeah, I can take a stab at it. I appreciate if you can set me straight if I say something off. But so the procurement order is a requirement by state to buy assets. It's more of a central decision-making sort of approach, right? So if we have to be in compliance and we have to demonstrate things by certain dates, we would obviously want to be in compliance with the regulator. The scenario that I showed you, that coming to fruition, is a function of many other factors. Just an awareness for you that a low price environment could exacerbate if we have to buy at current prices. We did an RFO, and Chris and team saw really high prices for some of the things that we would have to acquire to be in compliance if we were to buy them today. So it's just something that, we don't have to pull the trigger immediately, but it's something that we have to be cognizant of and be judicious about. So
Yeah, I mean, I guess I'll just add that we are an entity that strives to comply with all obligations, and so we will do the procurement. We have 2 buckets of types of procurements that we have to do, and one bucket can be met with storage and solar type resources, and the other bucket has to be met with what they call either long duration storage or firm clean resources like geothermal. And so we've got plenty of offers for solar and storage. As Scott said, they're pretty high prices, and so we'll have to do some of that procurement because we have to comply. And hope is not a plan, but the thing is, the more and more of these resources you add to the grid, especially solar, because there's such an abundance of solar, the more likelihood that it's not going to sustain its value over time because you get too much concentration of solar. And so that is likely. What we're trying to do in terms of managing the portfolio overall is, we have a diversification approach with our portfolio. We try to buy different types of resources in different tenors, different price structures. One way to mitigate this is not to buy everything at a fixed price, which is what we've been doing for the most part with most of our long-term power purchase agreements. So we're looking to buy some resources that are priced at an index, or figure out how to lay off some of our fixed price risk so that we can mitigate the additional fixed price exposure that we're taking on by these procurement orders. So we're working on different products and different types of things. We have a good pool of partners to help us try to figure this out. But it's a risk that not just we face, but all of the load serving entities face in California. Now, it's a little bit different for the IOUs because they have a power cost and difference adjuster, right? So when they take on these risks and they have stranded assets, they have the ability to recover those costs through a PCIA. We do not have that. But, it's something that we may want to consider in the legislative or regulatory space. Like, okay, if you're going to keep mandating these procurements that are putting us at additional risk, then you need to give us something to mitigate that risk as well. So that's something we'll consider in the kind of advocacy space.
Thank you.
Any other question? Yeah.
How does this compare to other CCAs and others like, not CCAs that are not CCAs, but are using clean energy, like Santa Clara or something like that? How does the risk scenario compare?
Sure, that's a great question. So their risk scenario is quite similar. Some mitigate it through their rate setting, and meaning they might set rates at higher than the utility currently or otherwise. They manage their PCIA risk in different ways. They take different approaches, use reserves. Some have lines of credit. I would say we are in one of the best conditions with regard to how much we have in reserves to help give us some peace of mind. Some are more strained and stressed and very concerned about their cash positions in the current environment. With respect to Santa Clara, Monica, I would defer to you maybe on the dynamic there.
Yes. So they're not CPUC jurisdictional, right?
Yeah.
And so they don't have procurement orders like we do. They do have clean targets like we do. Those are all load serving entities in California are subject to SB 100, which says by 2045, we have to be 100% clean.
Yeah.
So the municipal utilities are Santa Clara and Palo Alto, the ones in our area. Their city council set their immediate targets on what they want to be each year in terms of clean. And Palo Alto has a really aggressive, they've been 100% clean since 2013.
Yeah.
Santa Clara, not so much, but they are compliant with what is required by law. They don't have the same stranded asset risk that we do because they have captive customers. If you're in Santa Clara, you have to take service from Santa Clara. You don't have a choice. And they do not have a lack of load. In fact, they are growing significantly. In the next few years, they're going to almost double their load. So they have plenty of denominator to cover their costs.
Yeah.
And so Palo Alto's been pretty flat, but still not a problem there either. And they have really low rates. So and they're in a much better situation than the CPUC jurisdictional load serving entities, I would say.
Thank you.
Any other questions?
Scott, will the change in the fiscal year to a calendar year make it doing a stress test easier because you'll have more certainty with the PCIA?
Potentially, next year I would imagine we shift this a bit and get closer to later in the year when we have the more information. We'll never have all the information, but the shift definitely helps us have more confidence in the budget when we go to produce it and set rates for the year. So that's a kind of tangential benefit related to your question, I think.
Okay, and this is discussion, but I'll compliment SVCE on doing stress tests and making sure they're robust and you're considering different scenarios because it's a lot easier to go to the financial levers, understanding what the playbook is, et cetera. So this is good. And when do you do your next stress test? When's it in the cards now? Because I know it's fairly time consuming and labor intensive.
Yeah, so I'll mention kudos to Alex Krause and our team. Many were involved, but he did the bulk of the work, so appreciate him on his effort. We have not set our project plan for next year. That is actually a meeting that we're having in the next couple weeks. I would be recommending that we move it to later in the year to kind of keep it equidistant to the budget in terms of an advanced heads up notice before going into the kind of budget approval season. But Amrit can probably advise otherwise.
I can cover in when I go to budget framework. There's a calendar in the appendix that has the date.
Oh, perfect.
Time with everything moves. So the media budget now goes to June. I believe the stress tests, I'll have the calendar right now. So it's not item.
Yeah, thank you. I have a couple of questions. One is the P1, This is based on P1, right? The forward energy price collapse.
Yes, it is based on the first percentile of market price movement.
Yeah. How probable is that? I know, first of all, I want to echo what you said about stress testing. At least we are prepared. We are not caught by surprise. So
Yeah, so that's a good question. So technically it's a 1% chance that the price would be lower than that, something lower than that. There's also we'll probably have a similar conversation if we're at the second percentile or the fifth percentile, right? So we choose the P1 for the stress, and there's a spectrum of degree of impact, right? And there's a 50% chance it's lower than it currently is. And this is just giving you context of kind of an extreme, how bad could it get? But a first percentile would just be, you could think of it as a 1% chance.
I'll just add, if you look at the prices that Scott showed, remember those big arrows?
right, yeah.
So if you look at from recent highs, actually the current prices that we're seeing in the market is what we were stress testing a few years ago. So that kind of proves the possibility of past stress tests. We know these things happen, we can't time it, but this volatility is in our market, which is what we were explaining when we first started the process. So we're kind of living some of the stress you're seeing in a financial forecast is what we were stressing a few years ago.
And then on slide 12, we have historic natural gas forwards. I talked to you a long time ago how natural gas forwards and affects. So in this case, we know that natural gas futures have gone up tremendously. Because of the Iran war.
We haven't seen the increase in that. Normally that would be the case. That's what happened in 2008, the financial crisis. What happened was started with the Lehman Brothers, but it cascaded, right? The demand contraction, recession, oil prices were very high, then boom, same thing. You can see that drop. This is not spot price, it's forward price, which is how we model the 5-year budget. So this is what we were saying, that this is plausible in commodity prices. We were demonstrating that. And then back then, natural gas and electricity were very correlated. And there were still a strong correlation because on the margin, natural gas still sets the price. But what's happening right now with the Iran war is we've seen the oil prices increase, but we have not seen the corresponding increase in gas because gas was already kind of oversupplied getting into this situation. You've seen prices in Europe go up, and there's limited you have to liquefy and then transport. All those terminals were already operating at full capacity. So there's no ability for continental gas in the US to go to Europe. So that gas is still there. So this dynamics could change in the future, but that's why we haven't seen the increasing gas prices.
Any other questions? Not, I open for public comment on this item. Anybody wishing to speak online or in person? With that, we close public comment. Last, any committee members have any comments or thoughts? This is a discussion item. We don't have to.
I think as Monica mentioned, this could result in stranded assets. And I think that's something that the Legislative Action Committee needs to do right now.
I agree. I think it is a priority on the policy platform, the whole PCIA in general. But I think more specific to procurement orders and the kind of the direct risk that they pose to CCAs and other LSEs is an important thing to raise as well.
And I'll just make another comment. I saw the presentation that Mara did, which was
On IRP.
yeah, and it's what the CPUC is asking us to do, to think about, is incredible relative to what this is showing us, because they're at complete odds. Why would you try to get all this energy that, and then you're stuck with it. Anyways,
That presentation's coming to the full board in June. It's on the integrated resource plan. And the point is that we have to, in order to meet the targets of the greenhouse gas reduction by 2045, which is to reduce to 8 million metric tons, we would have to build a whole lot of storage and solar between now and 2045, because the major driver is that the state is projecting a huge load increase associated with data centers and electrification. And so Marin has modeled 2 scenarios, one that conforms to what the state is telling us is going to happen, and the other one that conforms to what we think is going to happen. And there's a huge gap, and you'll learn all about that in June. So, yes, central planning, this is what we do in California. So,
Yeah, I just want my initial comment about the sustainability. This is addressing my concern to be able to understand that. But thank you.
Actually, the next topic is also.
Yeah.
Okay, if no other comments, we'll close this item and then move on to item number 4. Recommend SVCE Board of Directors approve the financial levers table. It is staff report.
All right, thank you. Good to see you all. So this is a presentation we gave to the executive committee last week, so apologies to Brian for having to see it again. But brought this a couple months ago, 3 months ago, to this committee and to the board, and we've been kind of talking through this for the past 6 months. Ultimately, where this is today is really we're trying to take all the discussion we've had and the conversations and the analysis we've done, and translate that into something that we can kind of look at. We say, okay, we understand this is what the reality is. This is what our options might look like in the future if we needed to take certain actions, and get that kind of approved in a more formal way. But it's not taking action today to do any of those things. So that's kind of this playbook idea, is looking out into the future so that we can capture the conversation we've had and say, okay, we've done that, and now we're kind of planned for the future in this way. So I'm going to move pretty quickly. There we go. We're going to do a quick recap, and I'm really going to run through those, but they're here for reference if anyone has questions or we want to go back to those. Talk about what the recommendation for the board is going to be, and then really say, and what does it mean to recommend that, or what does it mean to have this playbook? Because I think the examples help make it feel more real. So the recap, we talked about SVCE's mission, which is about reducing dependence on fossil fuels, and you see the chart on the bottom left that really shows how that's happened over time. Electricity sector is a big one. That's a big part of what we have accomplished and are continuing to focus on. We just talked about some of the clean supply. Also, there's a lot of emissions from those remaining sectors, and that's what we work on with our programs. And then on the right side, we have the value proposition. That's both what we message to our customers. It's about rates, it's about local control, it's about reinvestment in your communities, it's about helping the environment, all of those things. We also know from surveys, talking to customers, these are things that they see about us. Different customers have different levels of awareness and different senses of what's kind of important to them. We talked about the different types of customers that we have. So this is just always helpful to be reminded. It's about 2/3 of our load is non-residential customers here in Silicon Valley Clean Energy. And also we talked about the bills over time. So that's the chart on the right. You can see they've basically doubled, largely driven by the increase on the transmission and distribution side. When we started, we were about half the bill. And now we're about 20-25% of the bill. Now, ours hasn't really changed that much. So what's driving the affordability issues is not really on our side of the equation. And then we also talked about our costs and revenues and sort of, the way we set rates. And I know this is the Finance and Admin Committee, so you all have a good sense of this. But really the takeaway here was, in this forecast, we're drawing from reserves, and that delta is significant. That's why we have the reserves, is so that we have the ability to draw on them if needed. And what actually drives those costs is on the far right. And you can see that a lot of those costs are the base supply costs. And so the rest of it is all, relatively small compared to what this gap might be. And so the takeaway from this slide really was, if these conditions continue, let's say off into the future, at some point, you have to raise your revenues in order to capture your costs. And that's, there's only so much we can shed from the cost side as well. Okay, and then this is a little bit of a drill down into the operating expense part of that previous graph, which was about 1 cent per kilowatt hour. But when you break that out into its constituent pieces, you can see here salaries, professional services, marketing, general and administration, service fees, data management. Some of these are non-discretionary. We have to have them in order to function as an agency. They help us with our billing. They're the interface with PG&E. Some of these support our programmatic efforts. They support our procurement. And then we also have other opportunities for savings that show up in other places like the prepay, which you saw on the previous slide. We talked about the levers, so what those are. The main three that we discussed on top of those, the operational savings. One is the clean. So we have a current clean target of 106% because we're covering our line losses on annual retail sales moving forward. The board affirmed, this is important to our mission. It's driven a lot of the savings so far. It's part of our core role as a load serving entity. When you look at those costs, you see that this has, it's not a main driver of our cost. The voluntary position that we have is not a main driver. And what Monica just alluded to with the additional constraints we're seeing in the IRP, this lever is probably even smaller than we thought because there's other constraints that hold us there. And so financial impact, not huge here. And so ideally, don't want to adjust this. This is important for continuing to meet our climate targets. We also talked about the programs. So this, we put some funding towards every year, and then because of a few years where we put some additional funds in, we have kind of an existing program reserves that we're spending down over this period. Board also discussed how this was important to the mission. It's really how our customers see us locally doing the reinvestment work. We're, driving this market transformation locally, something that we're uniquely positioned and sort of acting in. Also, not a huge driver on that cost stack that we looked at, especially on a long-term basis. We were also working on the decarb plan that Zoe's been working on, and that talks a little bit more about what to fund, whereas with this, we've been talking about how much to fund. And the board also talked about, we like these investments. We ideally don't want to adjust this either. And then the rates lever. So where we are today is 1% discount. We've ranged, up to 6% in our history. This, important to flag, as I said earlier, this isn't directly really affecting affordability for our customers meaningfully because the reason for the current crisis is being driven by the T&D side, and our part of the bill is much smaller. The Carefera discount, though, is something that, rather than, let's say, 50 cents on your monthly bill, it's actually more like $12 that customers are getting, so that can be more meaningful to them. But there is a competitiveness piece here where, being below PG&E feels important from a competitiveness aspect. But this is the thing that on an ongoing basis has the significant cost implication and the ability to actually recover costs. And ideally, we wouldn't want to adjust this either. So that was on all three of the levers. I think the intent is we like where we are. We also talked about the split product offering. So what might it look like to create, instead of one product like we have today, or we have a couple products today, I should say, but most of our customers are on Green Start, which is clean, it's at a discount. And really this slide is just saying, what if we change that Green Start and we actually split it and we said, well, we'll have one rate that is clean, but what if it had to be at a premium? And then we have one rate that maintains at a discount, but maybe it's not as clean. Maybe those customers can't participate in our programs. So we're not proposing that right now, but this is the idea of a split product that we've gone into. Things have changed. You just heard some of the forecasts, so I'm not going to spend a ton of time on this, but this fiscal year has improved from our original forecast. Next fiscal year has gotten a little bit worse. Other things have changed, new rate proceedings, talking about should we be redesigning some of these rates, talking about large load rate design. We've got our new IRP runs, new procurement orders, credit rating improvement, decarb plan, and continuing. So you see that this is the new base case that Scott had in his slides as well. I've just taken it and put it here as a line.
Can you explain the min target?
Yes, and the lines here show what our targets are for our reserves, and you'll see that we are above. It looks like we're above right now our max target, but actually that's The max is when you take out the unspent program dollars, whereas this line is showing with the unspent program dollars included. So we are forecasting on spending those dollars. So, you know, the true current days cash on hand, when you take those out, would look a little lower and would be below our max. Okay, so what's the recommendation? Continue to look for cost savings and efficiencies across our organization, just like we always do, but really, you know, focusing in on that this year. Maintain at the moment our current clean program and rate discount. And then if needed, the playbook says we would introduce the split product offering idea, where we would have one product that is less than PG&E, but it would be less clean and it would preclude program participation. And then we would have one product that is just like our current default, but might be at a slight premium. And we would do this. This would be our first step into having a rate that would be higher than PG&E. And so we would be using this to assess ultimately what the interest is of our communities, of our customers in opting down to that cheaper product, so that as we look into the future, we can understand what our opt-out risks might look like if all of our rates were higher than PG&E, because we needed to do that. And then we would also incorporate reduction in programs as well, because one of the things we heard from the board was we want to do it in a balanced way, kind of, you know, pulling all the levers a little bit where we can. And then the plan would be for the purposes of Amrit and Scott, as we're doing our forecasting, to continue where we currently are for 2026 and 2027, which would be to say to keep the discount, to keep the clean target, to keep doing our program work. So how will it work? We get the playbook approved in June. As always, our staff is monitoring the financial situation. That's what these stress tests are. That's what the budget presentations are. And in each future budget, we would know, okay, here's the playbook. Here are the options we have. Are we proposing some of them to the board right now in order to address the current financial situation? If needed. So we're not, if it's not needed, then we won't propose those things. But if it is needed, we kind of have a sense now, here's what we're stepping towards. And then the new decarb plan will also help us with this, because it will help us prioritize at any funding level for the programs. So here's an example, just focus on the chart on the right. I've drawn the same base case, and then I've said, let's say we continue as is for 2026, 2027, and then in 2028, we say, hey, the forecast is going just like we planned. Amrit and Scott have done a great job at forecasting, but that means we're still drawing down and we're getting below our target reserve level. And so we would like to follow the playbook, and we would come to the board as part of that budgeting process, and we would say, okay, we're going to create the new split product. These are what the products are going to look like. Here's the expected outcome. We would do that for FY28, and then in FY29, we would do the same thing and we would revisit it. And in this scenario, I've said, well, the forecast continues, and so maybe we have to raise the rates a little higher in order to capture our costs and stop the drawdown on reserves. So that's what this is showing, is how the playbook helps us in the future figure out what we can do. And then we can also model this. We can say, this is what we think the actions are that we might take. Another example would be, what if we did the same thing, or the forecast was the same, but we took action a little sooner? And then we didn't increase the rate, both of the rates. That would look maybe like this, where it's a slight improvement 1 year earlier, but we kind of end up in a similar place. And then the forecast could also change, right? And things could improve. And so that's what this is showing. The base case actually in the out years comes up on its own, in which case, maybe we took action in FY28 based on what we thought the forecast showed. And then as things change, we revisit that and we say, okay, time to close down the split product or move back to everything being a discount or anything like that. So the playbook really gives us this structure to use as we're doing our financial planning. So I'm not going to read through the recommendation again. This is the same as the other slide, but it's really to lock in that we understand this is what we have to do in the future, or this is what we may have to do in the future, which is to explore raising our rates. This is how we would go about that, but we're not actually taking that action now, and we would wait until each specific budget process in order to actually decide if it was necessary and decide how much, and to give the board that chance to weigh options at that time. Here's where we are in this timeline. We're targeting the board meeting in June to discuss this, and then in the future, we will put this in all of the budgeting processes. This will be something we reference and we talk about as alternatives and as options. Okay.
Can you go back
Yes,
just slides to your timeline? One more there. Sorry, I was just looking, so May, June, so this is our our recommendation would go to the board.
Yep.
And then the board would deal with the budget, this in the budget in September.
For all subsequent budgets, basically, we would just know, okay, well, is it time to enact part of the playbook? And we'll come talk to the board about it as part of the budget. Yeah.
Thank you. Thank you. Any questions from
Yeah.
the committee members? Yeah, go for it. Yeah, she,
Yes.
Good to see everybody. I'm trying to catch up to speed. So, regarding the split project offerings, and so I understand 2/3 commercial, 1/3 residential. So it's really the commercial clients that would affect us more. So are we looking at the split product as a way to obviously keep as many clients as possible, but really, the commercial clients are who we would be more concerned with?
I think we expect, yes, that our non-res customers broadly and as a percent of load are likely to be more cost sensitive and kind of
Yes.
aware of some of these things. And so, yes, I think that's the group that we would be most expecting potentially to affect. Now, I will say, looking at other CCAs, some have had higher rates than PG&E for certain amounts of time or will continue to do so. And the participation rates in those territories is still in the mid to high 90s, just like SVCEs. And so they haven't seen a lot of opt-outs happening.
Okay.
Our customers are unique. Every CCA is slightly unique, but some of those also have large C&I loads and they haven't necessarily seen them.
And then if you say less clean, is that less clean than what
Yes, than our current
less
target.
clean than PG&E?
It's hard to know where PG&E will be. So some years they have shown, at least on their power content label being very clean, and some years they show not. And I think, our expectation is that this would be less clean than ours, but probably more.
Less than 100%,
Less than 100%.
but probably more than
PG&E.
probably more than 80%.
Clean. So it
But
just
we don't
depends
know
where
when.
PG&E falls in that.
I just go back to, I'm looking around, I think I'm in here, the one that was here at the beginning when we were talking about all of this and why we wanted to do this. And it was really to be able to, offer cleaner energy. And so that's my concern is I understand there's the pricing and revenue and whatnot, but I guess it starts to, for me personally, just question, then what is our purpose if we're not offering something different, or cleaner than PG&E? I know the 1% reduction was, also important to some. I'd say from my community, that wasn't as much. It was really about being able to offer clean energy. So if we're starting to veer away from that, then, and I don't feel like we need to be in business just to be in business either. This isn't really, it wasn't really meant to be a business, right? It was an alternative to that. So that would be my question is how do we try to stay true to our original purpose? And I know we have to balance the books, but to do that, and if we are starting to get away from that, then it would, to me, the bigger question of, what is the point of our existence?
Maybe I'll just add too, we did also get some good feedback from the executive committee last week on this whole product split and what does it mean. And there are many, I think what Justin showed here is just examples of how we could differentiate our product offering. There are other things that we could do too. And I think what we'll work on kind of in our as part of the playbook is on what does that product mix look like and why we would offer it. And one of the things that was suggested perhaps is there's a community that really wants to be 100% clean, like maybe the city of Mountain View, because it's part of your climate action plan. And maybe there's a guarantee that would be for the city of Mountain View, that maybe a different city wouldn't have that same desire, doesn't have the same. But I totally understand why are we here if we can't be cleaner than PG&E. And I should say that directionally, we're all gonna be in the same place eventually. We have these mandates under SB 100 and some interim targets that we have to all meet by 2035, I think is the first target, that pushes us all to the same level. So our value proposition being cleaner is gonna be pretty much a moot point at some point. That's not where we do, and I think this is one of the earlier slides that Jess showed, is our ability to decarbonize and be a local presence in our community is what we think is a real strong value proposition. You know, how we can decarbonize our businesses and homeowners and support the transition.
Right, and to speed it up, the idea was to speed that up, right? You know, but you're right, if we all have to get there anyway, we'll get there, then I mean, it's 10 years out, but then what is our next mission after that?
And I will just say, I think that was with the board feedback we got, that was also the same. I mean, it's a difficult trade-off, right? Like, as I said, none of the levers is what I think anyone necessarily wants to pull. It's just, if we get to that point, how do we balance the things? And so it's good feedback. And I think when we actually bring it to the board of saying, okay, it's time to take this action, that would be an alternative we could say is, okay, you know, it could be at this level if we try to maintain the clean part of the opt-down or something, and what would that mean?
Yeah, and in terms of, like, you know, I wasn't here from the birth of SVCE, but certainly here early enough, but we may have started with one intention.
Sure.
But the reality is we became a load-serving entity in California. And with that came a whole lot of obligations, including these long-term procurement requirements. So we have commitments. We've committed about 70% of our portfolio of our load, our forecasted load, in long-term purchase agreements and prepays. So we are a business. We just are.
Yeah.
And with that comes, you know,
Sure.
obligations. With 2 investment-grade credit ratings, by the way.
Right.
Including one recently affirmed and changed to positive outlook. So we are a business.
Thank you. Any other comment?
Yeah, just thank you for the presentation, Justin. Can you go back to that, the slide that Supervisor was just talking about? Is that the recommendation that shows, so is this is the recommendation to do the split offering?
The recommendation would be for us to say that is going to be the path that we take.
Okay.
And it doesn't.
That's what you're asking today.
Yes, it doesn't mean that we're fully 100% committed to that, because we will come back to the board and say, okay, now is the time we're taking that action. Here's what the specifics are. Here are some alternatives. You can give us feedback on it then.
The finance committee, you're asking the finance committee to make that decision,
to recommend that the board adopt this, yes.
Okay. So then we talked before about the stranded costs purchasing. With the 2-step option, does that give or ease the stranded cost projection? I know that you've got a set of costs that you've already committed to. Does this give a better option for eliminating or managing those stranded costs in the future?
Well, I'll say part of it, and then maybe you can say the second part. But we, in modeling what the impacts would be, so when I was showing where am I? Here we go. Like these sort of impacts of this, we assumed certain things about, you know, what projects can we sell back on the market if we needed to, and so that would be a part of, or what attributes would we sell back onto the market. So that would be part of the forecast question, and there could be some stuff that we don't want to get rid of or we wouldn't, and so that would just shrink our ability to offer the opt-down as being less clean. It might be like, okay, we start with the opt-down still being 100% clean because we have some assets that we are kind of committed to in that way.
Okay.
Yeah, I think so. And I think the main thing so what the playbook does is it directs us to look at doing tiered product offerings, differentiating from where we are today. And like I said, we will develop kind of what that looks like and the details of that in the coming months before we bring anything to the board. The board's not going to say, you and the board approving the playbook does not automatically split our product offering.
Yeah.
That'll come later. What it does affirm, though, is that for fiscal year 27, which calendar year fiscal year 27, that we're essentially status quo in terms of We're going to continue to offer a 1% discount. We're going to continue to fund programs at 2% of retail sales. And we're going to continue to draw down our program fund. And we're going to continue to offer the current products that we have right now, which is Green Start, Green Prime, and Green Prime Direct. That's what it essentially affirms the status quo.
I understand.
Yeah. And that's an important thing because that helps direct Amrit in developing the budget that he needs to bring to the board in September and then again in December.
I understand, but this goes back to my original point of the drawdown of the reserves isn't sustainable. So there needs to be some other option to go in that direction to manage that, or to Supervisor's point, you dissolve the company, the business. So if you can't do it. So I think that this seems like it's the only feasible way to do it, or take a position of winding down SVCE, which I don't want to propose that, but I think it's a step in that direction to manage that. Once just and I like to give customers options. I always give my customers an option, and the option is do nothing, or be able to have a choice as to where you go with it. But I think also once you offer that option, it's going to be extremely hard to discontinue that option. You might be able to tweak the changes to it as to how much the percentage of clean is. But I think being able to, once you put that out there as an option for choices, if you take that away, I think your percentage of involvement would, basically anybody that wanted would probably go away. So just that sort of thing. So those are my comments. Thank you.
Probably it's all been touched on, but I just want to understand better. So if there were an option to have less clean energy, would that mean we would be procuring less clean energy? Because it doesn't seem like we're offering that right now. So how is that in our portfolio?
Yeah, so we're pretty much set for calendar year 26 and 27. We're already above 100% of our energy needs from clean resources. What it might mean is we buy maybe a little bit less going forward. But, Justin made the point. So in addition to these procurement mandates and SP 100, there is the greenhouse gas reduction targets that the LSE have to meet by 2045, which has us reducing, and you'll hear about this in the integrated resource planning process. So we have a further constraint that we all collectively have to reduce emissions to 8 million metric tons by 2045 in the electricity sector. So there's not a whole lot that we can do, as Justin mentioned, on the clean part of it in order to really fix the structural problem.
Right.
That's
I mean, that's what I was trying to understand. How is that even a product we can offer?
We can offer it in the short term, or yeah.
And I mean, it could be that the product, that part of that product is 95% clean, so it's like not a very significant delta. And yeah, we do a little bit less procurement around that. And that would even just depend on how many people choose to opt down into it, right? And so you get 4% of our load choosing to go to that, and then it's probably not, the final number probably ends up being pretty small.
Yeah, where we might have more ability to kind of make an impact is on the non-residential side and offering them products which they think are competitive, including what we currently offer under a custom product pricing offering that we have, which is what we call a pass-through product. So it's indexed to the market. The large commercial industrial customers like that product offering. Sometimes they want it to be 100% clean. So far, most of our customers have wanted that. Sometimes they just want to be essentially compliant. So we can do something like that as well. And that actually has the added benefit of reducing our stranded asset risk because we're not guaranteeing a fixed price for these customers. And they also have the ability to bring, if they have clean resources themselves, they can bring them to us as well. So,
but I will say that the split product idea here, the level we're talking about, even the premium product isn't making us a huge financial benefit in those years initially. But I think it's important to start with this first step product where we have an option that is still with SVCE, that is cheaper than PG&E. Truthfully, we just don't know how customers will react if that's a direction we have to go, where we have an option that is higher than PG&E. We have some survey results. We've seen what other CCAs have done. There hasn't been a lot of opting down and opting out, but before we took action to, if we, and again, this is all if we had to raise rates
Maybe
more.
28 at that point.
Yeah, then we would want to understand a little bit better, well, what do we expect is going to happen if we do that? And this would be a good way for us to kind of start in that path as an initial step. But you're right, especially the 2028 numbers there, like they're pretty small compared to where we are today.
Okay. Yeah, I mean, so many unknowns.
Yeah.
Especially who will opt which way, how do we do it? I do somewhat agree with Terry that once you offer that split, we can say maybe we'd go back to another model, but that may not be possible. And it may not matter because as everything becomes clean, there isn't that lower tier available, right? So, yeah, no, I think it's important to have the playbook and know that this is an option and know that we're not going to exercise that in the next year, but have this plan in advance of what's available to staff to present and try and resolve what can be a real financial calamity if we don't plan for it.
I should add that this board and past boards have been really good as far as seeing the future and planning for it and the reserves being a big factor there. And so I have every confidence that the board will do the right thing to make sure that we're able to continue to provide the programs and the value to the community, so.
One more follow-up. I mean, it was
I think
thrown
I'll-
out there. Oh, sorry.
I just want to make a quick point.
Yeah.
I mean, this is a good risk management exercise, right? We plan not to be in this position. If you look at the stress test and our next year, we're well covered, which is expected to be the worst year. And there's so much uncertainty in the forecast. There's so much uncertainty further out in time. We always look for 2 years. I'm going to touch on this in another agenda item. So this is a risk management exercise that we're engaging. We don't want to be in that position, but it's good risk management exercise. And also remember, we have rating agencies that look at these forecasts, that look at what the board says. One of the things we always hear, will your board raise rates if necessary to be financially prudent? It's an important message to that entity. That right now they see our forecast, they gave it a positive, S&P gave us a positive outlook, but they were also kind of concerned that our forecast shows drawing down reserves. A playbook like this shows that the board will do the right thing that's financially prudent if the need be. So this is a risk management exercise. Again, we plan for this. We don't want to be in this situation.
You answered my question.
Okay. No, you go ahead.
All right. Thank you. Just one kind of follow-up more at the implementation of it. I think that there would be variations of non-clean energy, specifically nuclear energy. Some view it non-clean, others view it as clean. And so I view it as clean. And so I think that there's maybe in the implementation of it, consideration on that to be able to have that program in there.
So we have an opt-up product right now called Green Prime, which is 100% renewable. It doesn't include large hydro or nuclear.
Yeah.
And we have about 2% of our customers on that.
If I count, yeah,
Yeah, and they pay a slight premium for that. Yeah.
to cover the costs, yeah.
A good point. And by the way, in SVCE, our board has determined that nuclear and large hydro are clean resources. So.
Yeah.
I'm gonna ask my questions first and then I've got comments, but that'll be after public comment. My first question is, what changes, if any, were made to this presentation from the executive committee presentation? That's what I thought. I didn't go and look at them both. Okay. And what about, have you considered changing our rates in terms of what the mix is of rates, like if you think of time of use, whatever, and elect and all the various, the EV rates, all of those, have you thought about that? Because I'm not sure you need to change all of them, but some of them.
Yeah, and we've got a couple pilots that the board approved, right? So that they're gonna be coming live in the coming months. So that's us kind of entering into this idea of some of this. But I think, yes, like in terms of the implementation piece, if we get to a point where we're creating these split rates, it may make sense for us to think about slightly different rate structures altogether, because there's, you know, the way the rates are designed today is done in a certain way, but that's not maybe the way that better aligns with some of our costs. So there could be some opportunities basically there, is what I'm saying.
Okay, so that's a good thing, not a bad thing.
Yes, I think so. Yeah.
Okay. And then how does and I'll use BACMed decision affect product offerings and rebates?
Area management.
This is, yeah, exactly, because that's gonna be the mandated change. That I think is gonna be fairly controversial, but also it will affect demand and how, and I'm talking just the residential customers though, right? But I think it also flows into the commercial small business side.
I think it's a good question. It speaks to the challenges that would exist in scaling down some of the programmatic support that we have in place that the Air District rules are looking to and are thinking about as they vote to approve or not on that. And then today, if you switch, it is cheaper to operate the equipment, all electric equipment. And so I guess if you're asking about what are the implications of like rate decisions on the rules, if people are now switching more and more to electric equipment, that should still deliver those savings, but that's something that we would want to look at as we are setting our own rates to make sure that we're still kind of delivering that for customers.
I mean, theoretically, it would increase our load too, right? And so under this structure, probably wouldn't be a good thing, but under a structure where our costs are lower than our rates, it would obviously help as well.
But it's in our forecast. We have some assumptions around that.
Right, but and then again, I'm kind of making a comment, but if you change your rate structure so that you're during the day or under a certain rate structure, you could have a lower rate and in the evening a higher rate,
yes.
So that people that
demand flexibility, responsible. Yes, those are all things that I think would feed into this. So because if there's a way where we can find to lower our costs for the procurement requirements and all this kind of stuff. Now, Monica would say, but it doesn't matter in some ways. What the reality is, it matters what you get credit for with the agencies. And so that's a whole other story and topic. But yes, we are thinking about it and looking at it.
And it's just, there's so much uncertainty as said. So I've got some comments later on, but those are my questions.
Thank you. I have a few questions, starting with simple slide 4. Why is 2016 missing?
Let's see.
Because our service didn't start fully until 2017.
Okay.
Yeah. So, but our base year is 2015.
Okay.
Yeah.
Okay. And then on slide 5, the generation rate is is around 11, I think. The
Cents per
orange,
dollar.
yeah. But if you look at the next slide, our generation rate on the left side, it says 7.7 plus on the gaps. On the cost side, it's 11 cents.
Yeah. Because when we set so this is just the SVCE generation rate, but when we show it on the previous slide and what the customer sees for their gen rate, it includes the PCIA.
Okay.
And so what we're showing here is the SVCE plus PCIA, because that's really what customers perceive as their generation cost.
Okay. Thank you. And then the next slide, slide 7. What is PG&E service fee? Looks like there is so much double dipping happening by PG&E.
Yeah, there
are
are costs for them to essentially give us information, give data, the interface with them. There are fees that we pay.
4%. Okay.
Yeah, we don't have our own meters, right? And so PG&E is they meter
Right.
load for us, and then there's a cost associated with
Yeah,
that.
They are our cash register.
exactly, exactly.
They collect all of our money.
And then it looks like transmission and distribution is going up and the other question I had was, you mentioned about, what, do we know the elasticity, especially on the non-residential side, to the price delta of SVCE and PG&E? Do we still offer them 1% discount or?
Yes, we do. And I should say, the value that all of our customers get, but especially the non-residential customers, we do a lot of work to engage with them and make sure that they, know who we are, that they're getting value from their relationship with us. And that's why the board has approved things like our CNI decarb program. It's why we've got the non-standard pricing agreement policy that you have approved so that we can work with some of these customers to make sure that we're kind of meeting their needs in a unique way if they're a large enough load. So yes, we know that some of them are going to be price sensitive. Some of them are just, well, tell me what the thing is, and that's the action I'm going to take. We talk to them, so we get a sense from some of them, but we don't know in aggregate across the full 2/3 of our load that's there exactly how everyone's going to respond, how much they will, value the rest of the value proposition that we bring to them. And also there's a year-to-year variation. Historically, we've delivered all of this value to all of our customers in a lot of different fronts, but including on the bill savings side. There may be a couple years where we do something different that looks like this, and then maybe we toggle back. And customers can't switch right away back and forth from PG&E. So there's some risk too in leaving from an entity that really has been supporting you in this way all this time.
That was, thanks for answering that. That was the cost of churn. How much quickly can they opt out and opt in kind of thing. So thanks for answering that. If we don't have any more questions from the committee members, I'll open for public comment. Is there anybody wishing to speak on this item?
No hands raised.
Thank you. Do we have any final comments before the motion or any questions? Yeah.
Just go first.
I was going to ask for the clicker. Go ahead.
It's more final comments before the motion, but just my perspective that I think the comment about the credit rating is, we didn't discuss it a whole lot, but I think that's very important because it really gives the financial management ability to be able to use money in a case, and that I think is very important. The other important aspect of it is that indicating where I sit on this, but that flexibility of the pricing that I think is necessary to sustain SVCE as a business and as a viable business. But we need to be careful as how we implement it, but I think we need to have that flexibility. It's not a Model T, one product. We need to have other products. Thank you.
Okay, thank you.
Okay, so a couple of comments, and you may have be hearing these for the second time. I think small businesses are very price sensitive, and I spoke with a SVCE customer, and they said as soon as the rates went above PG&E, they were gone. And a lot of businesses are being pushed right now. So if you could go to slide 10, please. Now, this is, I think, is this residential or is this across all rates? Okay. I believe and I would recommend that having a nominal discount to PG&E is very important to keep our customers sticky. And the cost of switching may be too much, but so they stay sticky. But that's not what the underlying feeling is. But now, Amrit, your point about we always have to be able to raise rates. I mean, there's no question, but I don't think the X should be over at the right-hand side, but that's under a stress case scenario. The other thing, Margaret, you spoke to, well, you know, why are we in business if we can't offer a clean product? I think a huge differentiator is our ability to provide programs. And I think that's really, we add a lot of value there that I don't think other IOUs add. And so I think those programs that are tying those to our product is very important. And the other thing is, if we do change our rates and we do a split rate, whatever, you know, you can't apply for all these rebates and then all of a sudden leave to a cheaper product, if you will, a less expensive product. Could you go to slide 13, please? So I appreciate that you see different things in graphs, but this ties from the stress test slide to this presentation. And I think if you use almost the identical slide, it would be better from a word perspective, just so that I look at this and I have to say, okay, that was the graph that Amrit showed with the bars. And so, okay, so that was my comment, but I think tying the two together very closely is important, and that would help. So that people understand, you know, if we're seeing this happen, then we pull out the playbook. And I think and I'll compliment you once again on the playbook, working together and saying, you know, it's not an algorithm, but it's a playbook. It's, if this is going to happen, we're going to be able to deal with things. And I think that's the message for the credit rating agencies. So I compliment you once again.
And our developers too. Remember, people won't sell us products or contracts or PPAs if they don't think we're going to exist. And so it's right. We have over $4 billion invested in power purchase agreements right now. So they trust us now. Very much so.
What was the number? You just
$4.1 billion.
4.1 billion.
Yeah. I'll also make the comment that really managing ourselves going forward is something we've done well in the past, and it's good to see that we're continuing to do that.
I agree with you. I've been thinking about the cost piece or the pricing piece, just because, you know, you probably have heard for the county, we're looking at going from green prime to green start because it's over $1 million difference, and you know we have a huge budget deficit. So I do think price is very important. And yeah, that's what I've been, you know, it's like I said, the 1%, going back to what we started from, you know, what is it that was, and we all had different opinions, frankly, you know, depending on which community you're from. Like my community wants the clean. I think some of the South County folks wanted more price, you know, lower prices. So I think this is important to have the levers to adjust accordingly. But I do think at the end of the day, price is probably going to become even more important. And I agree with you that was the whole, you know, idea was like, we don't have to make profits. So whatever money we bring in extra, we can put back out into the community. I guess this is just making me question, like, if we have to start raising rates to do that, like, what's the real cost benefit, I guess, of that? Like, we just kept rates lower and let, you know, folks have cheaper clean energy. Is that the better way to go than to have programs? So, and I think this is covering all of that, and we'll, you know as we go what to change as we move forward. But I think that, yeah, and this is more philosophical and beyond this committee, and, you know, and I apologize, but it's really been making me think about, okay, like, we're about 10 years in now, right? So what's the next 10 years gonna be? And if we're getting close to that target, like what happens once we hit that target? Are we gonna be able to compete with PG&E? Like, can we get into the transmission business? We've talked a little bit about that, to be able to do that cheaper for our residents or not? Will the state continue to block us from doing that? And if that's the case, then yeah, like maybe we've achieved our goal and that's okay too. So these are just things that I think for the next 10 years, we just need to start thinking about.
Those are all really good points, and I should probably add in, you didn't get the benefit of being part of the board workshops that we held, I think starting
December, right?
Yeah, December, and so we did a
Yeah.
whole
I'm sure you
day
did,
on this, and it was a really good discussion between the board on more than the board, it was alternates, everybody. So a lot of this, a lot of what we presented today was informed by those discussions, discussions with stakeholders, community, et cetera. And then the decarb roadmap that Zoe's gonna present to the board in June, the next iteration of it talks about that too, like
what's next?
what's next too. Yeah, so all really good. I don't think any of us envisioned 10 years ago that we would be here today.
Yes, yeah,
And not here in a bad way, here in a
in a
great
really
way,
good way, yes.
in a
yeah.
real good way.
Yeah, no, I'm really excited, yeah. Thank you, thank you all.
With that, are we ready can we bring slide 15, please? Are we ready to make a motion?
I just wanted to comment, I mean, this was looking at how this playbook came together. It feels like a lot of this came out of our discussion at the special meeting in December. And so, seeing arrows, seeing the balance, seeing the trade-off that we had. I mean, that was a challenging meeting and, in terms of trying to pick which things we thought were more important. And I think this captures it. So, there's just so many reasons why we need to do hard things right now and, maybe rethink certain assumptions that made sense 5 years ago to keep going. So with that, I'll make a motion to, let's see.
Staff recommendation.
Yeah, I recommend the board approve the playbook of ongoing search for cost savings and efficiencies, maintain current levels of clean programs and rate discount at a minimum. If needed, introduce the split product offerings to assess opt-out risk and interest, and scale up costs for both products over time if needed, incorporate small reduction in programs, and plan to continue as is 26 and 27.
Yeah, thank you.
I'll second.
Can we have voice vote, please?
Yes, all in favor?
Aye.
Any opposed? Abstentions? That motion carried unanimously.
Thank you. With that, we move to item 5, budget framework for stub period, October 26 to December 26.
So we have 3 items in short time, so I'm gonna speed this up a little bit.
Yes.
So a quick recap, Margaret, I don't know if you're not here. We are changing our fiscal year to calendar year, and the main driver was to align with the December, January rate changes. We have budgets in December as opposed to redoing the budget in 3 months. So we have a transition, this is our transition year. Our current fiscal year ends September 30th, 2026. So we need a budget to function for the fourth quarter, and that's what the stub period is. So normally we bring the framework, this is the framework discussion just for the stub period. And when we get to the calendar year, we'll bring that to the committee in August when we'll talk about the framework for the full calendar year 2027 budget. And Brian, I just wanted to address the question you had earlier that you running stress tests on the calendar. We're gonna do that in August going forward. And the board will approve that in September. If there are any changes to reserves, it will happen in September, so December, we're ready to implement the new budget. So in our new fiscal year, after this transition year. Okay, so in terms of the stub period, we've never done a 3-month budget, and there's some uniqueness to a 3-month budget. It's very hard to time expenses when we conduct our business on a 12-month period and we budget plan, and even the way payments work in our industry tend to be over a 12-month period. I gave one example here, and that has to do with the renewable energy credits. Remember, this is the budget, so we can budget in a certain period, but when they transfer those credits to us is when we make the payment. So if they happen to do so within the 3 months, even though we didn't budget for it, we could end up paying for it. So there are those type of nuances we can keep in mind for the stub period. And it says, we have a lot of seasonality, and same with our internal budgeting process. The good thing about rates, which is the hardest part in setting the budget, how do we forecast revenues? For the stub period, it's not an issue. We're going to continue with the rates that were approved in January. We're going to ask the board to support that in the budget because we align our rate changes with PG&E's rate changes, and we don't expect a generation rate change for PG&E or the PCI rate to change till January. So that will be addressed in the annual budget to the board for approval in December. It used to be the mini budget, now it's going to be the full budget. First time they'll see the budget for the new fiscal year. So we're going to ask, these were the current rates that were approved, continue with the 1%, bill credits, CareFera, and the green prime rates. That's what we're going to ask the board to approve, and we bring this stub period budget for the committee to review in August. That's what it will be based on. Reserve targets, normally when we do the stress test, we revisit the reserve targets. Again, this is, so that we don't have to implement one of the playbooks. One of the key things is, as Scott said, key risk mitigation for us is having ample reserves. And as we've done that, we have the ability to absorb financial hardship we're forecasting for next year, right? So this is every year we test are those targets the right targets. Same recommendation as last year because we are already in the stress period, and the implied targets really don't have many practical implications. For example, currently it implies raising our upper limit. We're forecasting not to even, to be honest, business as usual, to be drawing down reserves. So this is not another second year that we don't recommend any changes to the reserve targets, and that's what we will not be adjusting the financial reserves policies. Targets this year as well. Power supply expenses, I'm going to focus on the last column here. All of what we do normally, we plan to do, hit our clean targets, everything is in play. The budget policy and contingency, and this is an item next on the agenda. Normally we put contingency in budgets, but for power supply expense, we don't really explicitly put a contingency for volatility in prices. And we moved that a long time ago to the budget policy. Why? Because adding a $30 million contingency, how good is that budget? And how good is that financial projections? That doesn't work. So we said, the board gave explicit authority to the CEO to overspend the budget for power supply if the expenses exceed budgeted at a less of 10% or 30 million. That's the current budget policy. We're going to be revisiting this target. That's a discussion for next agenda item for different reasons. But what we're asking is for this stub period, we recommend to the board to suspend this provision of the contingency for the budget policy and instead implement a new direction, which is not to apply the 30 million or the amendment I'm proposing in the next agenda item, but to just apply the deviation based on percentage, allow for 15% for the stub period budget. Again, we talked about difficulty in managing the 3 month, and also the 30 million is a 12-month figure. It's not really appropriate to apply. That's way too much headroom, right? That would not be a good governance. So that's what we're proposing to recommend. The other items that we normally addressed are like benefit changes. We don't have to do that. The good thing is our new fiscal year aligns with when staff benefit changes occur, which is January 1st. So now we can bring that discussion to the December budget, and we will, if we have proposals, we're gonna bring it to the Finance Committee in August when we talk about the framework for the December budget. The other thing is salary and adjustments for COLA or merit. Normally, we do that at the beginning to be effective when we start the fiscal year in October. We're saying let's transition to a new fiscal year, do that in January. We recognize there's a 3-month gap in there. If we want to account for any of proration or anything, we can discuss that in the August budget framework. But stub period, we don't have to consider that. For the stub period, we recommend we continue with our current board policy of transferring 2% of the stub period revenues to programs fund. And on the other operating expenses, as Justin said, 90% of our expenses are power supply. The other 10% or so, we normally add a contingency in the budget and we spell it out in our reports. We ask that we continue to do that for 5%. We are tightening where we are taking initiatives to tighten that contingency in the budget. And if you remember when we brought the financial projections, we took $6.5 million out from those projections for these contingencies. But for stub period, we're recommending that we add a 5% contingency because of the difficulty I talked about, the timing of expenses and how we budget. And we will spell this out as a separate line item. Now, in terms of looking at the prudency of what we're proposing, normally what happens, we present a forecast budget and we compare it to prior year's budget, right? And so we justify any increases or decreases. We won't have that. So what we're recommending is we can compare to the actual expenses for 2025 Q4. It's not an apples to apples. One is the actuals. There are a lot of reasons actuals can differ from budget. But I think it will still be a good comparison. And one of the difficulties will be that contingency, that 5%. And as I said, we'll break that out as a separate line item. So that's sort of the how we plan to put the budget together. So the next steps will be, if the committee agrees or has any recommendations for what else we should consider for the stub period, that's what we want to hear from you right now. Our plan is to bring that budget for the committee's review in August. That's when we plan our next meeting. And then the board will approve that in September so that we have it before our current budget runs out at the end of September 30th. Remember, in the past budget cycles, we used to take up a draft budget in August and then again, and then end up usually being the same budget again to the board in September. With the change in the fiscal year, we don't have that. So the board will have one opportunity to look at both the stub period budget and also in the December budget of the fiscal year 2027. So with that, I open it up for discussion and any feedback, so we can incorporate that into the budget development process.
Thank you. Any questions from?
Yeah, what's the projected budget for the stub period?
We don't have that yet. We have some indication, actually, Scott, we have some estimates, right? Could you?
Divided by 4, maybe?
Yeah.
Yeah, do you have that from the internal?
For the stub period?
The IROC, the one that Marvin put together.
Oh, yeah. I couldn't hear them, the microphone.
So,
What was
proxy.
Yeah, I understand.
And it's gonna be a very negative number, because remember, we're looking at whether our rates are low right now, right? We're projecting it to be, this is also a stressful year.
Do you want me, Amrit, did you want me to pull up that report?
If you have it quickly, I think it's if I remember correctly, it was around negative.
I can find it. If you take the next question, we can come right back to that. Pull it up.
Any question?
Just a question on the numbers. You were saying 90% of the expenses are energy expenses. 1% from an earlier discussion was the operating expenses. What's the other 9%?
The other operating expenses, all of it is the 10%. I have 1%, I was probably a subset of that.
Okay,
No, I think, are you referring to 1 cent per kilowatt hour?
no, it was the 40 million. There was a 40 million operating expenses,
Yes.
that was 1%, I thought.
No, that's about
it
the
was
Oh,
budget.
1
that's 10.
cent,
That's 10.
1 cent.
Okay, oh, okay, oh, okay,
1 cent.
okay, all right,
So that's about.
okay, gotcha. So it's 40 million, oh, the 10% is the operating expenses.
Other operating,
Other
unless you take energy costs out.
Gotcha, okay, thank you. That's all.
Okay, thank you. Any other questions?
This is a discussion, so I'll just make a comment while we're waiting for this. I guess, we need to get to the new calendar year equals fiscal year equals calendar year. And we won't recognize the benefit of changing the fiscal year to the calendar year until we're there, but it's gonna have I think it'll have a significant benefit in terms of the number of meetings I've sat through. Here's a preliminary budget, and we're gonna have a final budget, and this and that, and it's just always been a lot of work. And that benefit where we're gonna get to comes at a cost. And this stub period is the cost, the effort that's going into it. But what I'm also hearing is that it could be not a pretty 3-month period. And it would be super helpful to see if you knew your actuals for the 3 months last year. And I think when Mara Councey puts the numbers together by quarter, they're pretty good. And so just to be able to see that, first quarter of the old fiscal, or first quarter of fiscal 2026 against the budget for, which will be the stub period for 2026.
Yes.
Seeing those numbers will be really helpful for everyone to understand, yeah. But this stub period's a one-time event. We have to get through it to get to the benefit.
Need a
I
budget.
have the slide number if you wanna, did you want me to
If you
pull up
wanna
the
read
data?
Just the one number is all
Yeah.
I'm after.
Can we do
Yeah, I
this?
can show what it looks like. This is how it looked, not actuals. But this is how it looked for the same period. So this, when we did the mid-year budget, we would have forecasted this period, even though it wasn't part of the budget year. And there's a lot of seasonality in it. So this gets to Amrit's point earlier where it looks bad, but in reality, our rates are lower in the winter months. And so we collect money in the summer that effectively covers some of the winter just because of the seasonal rate design versus how we incur costs. So you can see here, since then, we're showing it's about 4 million better, but it was overall targeted to be behind in the red 32 million, and that is now 28 million as of this past week.
The rough estimate about negative 28, but again, that 8 million, we haven't really done the projections. It's included right now.
How do you then give the CEO discretionary spending on a negative number?
It's on the power supply cost.
Oh, okay.
So that's.
Okay, that's the
80,
87.
Yeah.
The 87,
That's a
okay, all
positive
right,
number.
okay, thank you.
In the interest of time, I will defer my questions. Thank you very much. We go for public comments. Anybody on public?
No hands raised.
Okay, thank you. We are running 15-20 minutes late already. So any comment? If not, this is just a discussion item.
Just a discussion, so.
We move on to.
You know what to expect in August.
Yeah, we move on to the next item, item 6. Recommend SVCE Board of Directors approve changes to fiscal policy. Yeah.
Okay, so this is the budget policy that I just referred to. And what we're asking now is is for the committee to approve it, or recommend that the board adopt this, change the budget policy. And what we're changing is basically that contingency, the power contingency that I explained in the previous item. Right now, it's the lesser of 10% or 30 million. We're asking it to be increased to 15% and 50 million, lesser of, and you may ask, why are we asking for this? This is for ongoing full calendar year. The reason has to do with the change we made in our energy risk management policy. And if you remember the stress test discussion, right? Prices come down, we don't do well. And the reason for that has to do with the PCIA. PCIA goes up when prices comes down. The change we made in energy risk management policy is say, hey, let's not create budget stability. You know, if we hedge our portfolio, we can basically reduce budget volatility, right? Because let's say we were able to perfectly hedge and lock everything in before we even set the budget. And let's say theoretically that would be possible, it's not, but for understand at a high level policy level, let's take that. We can 100% hedge it, then we know what our cost is. You approve that, we have no volatility in the budget. We have volatility in our financials because if I lock that in and prices come down, what happens is I don't get to participate in that drop in reduce my power purchases. But I know next year PCIA is going to go up. What if I can take that drop in my power supply cost this year and offset the increase in PCIA next year? So there's a hedge there that comes from the because the PCIA and our power purchases are both settled in the CAISO market at the same prices. So it's the same exposure coming from the same price, right? So that's what we would call a natural hedge. So what we said is, instead of creating budget stability, let's create financial stability. And as you remember, we've always said, look at our budget, not 1 year, 2 years. You cannot bank, if you look at stress test slides there too, you cannot bank 1 year's margin, you gotta look at 2 years. That's what this change is about. And then there's a corresponding change. Obviously, if you, to cover the exceedance in the budget, we may need to draw on the reserves. This is the authority given to CEO for these purposes where power expense budget is exceeded, the CEO has the ability to draw on reserves without going to the board. It's the same parallel provision in the financial. That is the reason we're changing it. Now, I can go to the complexity of and explain these dynamics, but if that made sense, I can move to the next item. This is basically slides that show that dynamics that I just explained, where right now on the top, you can say before ERMP, energy risk management policy change, the flat line in reality is never flat, it's wiggly. There's always volatility. That's why we need budget contingency. But in principle, we're creating budget, but we have financial instability. With this change, the policy where we allow this year's price, our procurement cost to come down and offset next year's increase in PCIA, we're creating more financial stability over 2 years rather than budget stability. Because we don't have budget stability, we need to increase this contingency. The way we derived it, Scott did the analysis, he said, well, trying to get comparable to 10 and 30%. With this change, we need about 15%, lesser of 15% or 15 million. And also the other thing that's changing is with the fiscal year change, we won't have, to save time and all that, we also won't be revisiting the budget as often, right? Every time we were revisiting the budget, we wouldn't change the department expenses, but we will always update our supply expense for this reason, gave us the opportunity to stay within budget. So that also plays into needing a higher contingency. So that's what this graph illustrates. And then I have some numerical examples that demonstrate the same concept. You can look at the exposure on the right, the 30% that we now allow to move with the market, estimated 30%. And this is just an illustrative example to demonstrate. That is subject, that creates the budget volatility. And in the next slide, I show that volatility before the change, after the change, assuming the strong assumptions that you can achieve perfect hedge. Before the energy risk management budget didn't vary as much. Here I'm showing 0, assuming perfect conditions. But now I'm saying we don't have that variability in our financials. We allow ourselves the opportunity to capture lower prices. Prices come down. But remember, the flip side is also true, right? As I said in the staff day, there's no free lunch. Right now, prices are coming down. So with this, let's say 30% left to the market, we're enjoying. That's why this year's budget, right now, our current projection is we're going to break even and maybe slightly add to the reserves as opposed to the mid-year budget, which was 12.5 million negative because prices have come down. We're able to capture that in our portfolio. But it's going to offset some of that degradation in financials in 2027, right? Because we'll have that money. But the flip side, no free lunch is when prices are increasing, budget will go up, right? And the next year's PCIA will come down, that's good. But that gain in next year's from PCIA going down because prices went up will be eaten up by this year's budget exceeding. So you can't have it, there's no free money out there. This is risk management, right? You're shifting risk. You're saying, I don't want big distributions. I don't like those. One time I'm rich and one time I'm out of business. I want to shrink that. That's what risk management is. And the policy change reflects that. We want financial stability, not the optics of budget stability. That's what this request is. So with that, all that makes sense. We're asking the committee to approve, recommend that the board approve. I would recommend you not read this, just say it has stated there. I also ask that you recommend that we present this via consent calendar for board approval, given this is a technical matter and the committee has, the board can rely on the committees who have done the due diligence.
Any questions from the committee members?
There's, if I recall correctly, and maybe it's not in this one, it's when do we revisit? And this is a question for Michael. Is there a revisit date in this policy? Because I think you're adding that in all the policies now.
Yeah, I think it's budget is at least 5 years, I believe. They all have it, yeah.
I can confirm, but yeah, it's I believe it's 5 years for this budget, for this policy. And staff,
Sorry, Mike.
I'm just gonna say staff, go ahead, Helmut.
Every year, the reserves every year we review, right, as part of the stress test. But the budget, I believe, is 5 years, Mike, sorry.
I was just gonna say, and staff may review them sooner than that cadence if, things like this arise.
Oh, okay, because I like to see, it'll be the next one where I want to see it revisited more frequently, but it is 5 years for this, correct? And that's a maximum? Is maximum?
We can bring it up, but we brought this change in the February committee meeting too, remember? We got rid of the draft budget. So this is the second time we're bringing this year.
Okay. Well, I'll certainly support both recommendations. So those are my.
Quick question, the 50 million, has that been 30 million, has that been the sets for the last 10 years?
I believe we set it in 2022, if I recall.
Okay.
Margaret was
But
here.
something like that.
We never really had to use the full $30 million, right?
No, yeah, but if you look at this year, prices coming down, so it is not the same magnitude where if prices were increasing,
Yeah,
we would exceed. Yeah.
you'd exceed 30 million, but not 50.
Yeah, 50 would be close, would
Yeah.
be getting close, yeah.
Okay, all right, thank you.
And confirming the update is every 5 years for this policy today as a minimum.
Thank you.
As a maximum.
Yes, I meant sort of at least every 5 years, but yes, you're right. No
Please.
longer than 5 years.
Okay,
Okay.
if there are no questions, open for public comment?
No hands
No,
raised.
okay, thank you. Any other final thoughts before we go for
I
the?
believe that was action items.
I'll make a motion and staff recommendation.
Yeah, thank you. Any seconds?
I'll second.
Okay. We have voice vote.
Yes, all in favor?
Aye.
Any opposed, abstained, that carries unanimously.
Thank you. Next is the item 7, recommend SVCE Board of Director approve changes to finance policy.
Yeah, so this is the capitalization policy, and if you remember, for those of you in the committee, last year, we had our accountant Maher, Mike Maher from Maher Accountancy discuss GASB 96, gave a background of it. We implemented it for fiscal year that ended September 30th, 2025. At that time, we said we should have a threshold rather than be, vary year to year. And we said we'll come back to the committee. We didn't have time to do it in February. We're bringing it now. So this is something we had discussed before. So very quickly, what am I talking about? What is GASB 96? So GASB 96 basically covers subscription-based IT arrangements. As you know, a lot of software right now is cloud, software as a service, not in-house development. And what the accounting standards came out is saying, well, similar to leases, you should be capitalizing these. In other words, record an asset and record a liability, right? Just as you would have done had we built software. And just as we do for capital assets, hard physical tangible assets like office furniture, vehicles, building, and we have a capitalization threshold of $5,000 for that, right? So now we do this for I'll just call it SPIDAs, basically subscription-based IT services. Okay, so we have to record these as an intangible asset because we have the right to use this and a corresponding liability on our balance sheet. And it's very normal to have a threshold. As I said, our capitalization policy has a $5,000 threshold. And the idea there is you don't want to take on administrative cost and burden when it has no material impact on the balance sheet. It does not convey any, it's not, no one's going to walk away with a wrong understanding of your financials by looking at your financial statements. And so all these, the entities we look for that would provide guidance on setting a standards like Government Finance Officers Association, they don't provide a specific threshold. They also support not capitalizing small items, and they recommend periodic review of the capitalization threshold. GASB, which came up with the standard, GASB 96, which basically sets us the gap for governmental entity or generally accepted accounting principles, they also don't prescribe a threshold. They won't. And the reason is why? Because it's up to the management judgment. What is administrative? What is material for your business, right? Something that's material for our balance sheet, which is had a net position of $507 million as of September 30, 2025, may be very different than another entity. So what we're proposing, working with our accountant and having gone through implementing SB 96 for our last fiscal year, we're recommending a threshold of $250,000. This would be on a net present value. When you look at $250,000 with the $5,000 for physical assets, you may say that's a huge number, but you got to remember the work entailed in applying GASB 96. Furniture, things like this, stapler may last a few years, but we don't want to capitalize that. Everyone knows that. That's too much of an administrative burden. But with GASB 96, there's a lot of criteria and thresholds. You have to go through each contract. Each contract is unique, certain provisions that can trigger GASB 96 treatment or not trigger. So that staffing time, that accounting time, that auditing time is much higher. And we looked at across the industries, some governmental agency out of states were in the $500,000 to $1 million at a threshold rates. And we anticipate we may have 5 or 10 contracts that would fall below this threshold. And then the impact on a balance sheet, as I said, is gonna be small. The question you may ask is, what about all the small ones? If they still have a future liabilities, future payment obligations, the contract is still in play. What if in aggregate they add up to something that's material? So we will review that at least on an annual basis. And if we feel that has reached the threshold, we will then make a recommendation as to how that should be treated on the financial statements or in the disclosure of the financial statements. So that's the recommendation. This was a to-do item. We don't want to have no threshold. This is too arbitrary. This shows consistent treatment, clean audit. We also run it by our current auditor, the 250,000 threshold. This is again on a net present value basis. We discount all the future payments under the contract. So with that, I'll take any questions, and after that, this is an action item. We ask the committee to recommend to the board to approve, and also recommend that staff present this technical item as a consent item for the board in June.
Thank you.
Thank you. One question, I mean, you anticipated 5 to 10 contracts annually below this threshold. What about how many would be above this threshold? I mean, I know it changes.
Maybe, I think last year we had, I forget the number, I think 4 to 6, somewhere between, I'd say about 5 contracts or so. We have a lot of small contracts like on the program side, all the marketing, Rock Rabbit, Grid Shift, all these little software that we implement. They're tiny ones. Those would draw. That would be the 5. The big ones would be obviously our Microsoft, portfolio risk management, our procurement, Ascent Analytics. Those would be the big contracts. Those would definitely hit the threshold.
Just a comment being in the business that this is just gonna grow. The subscription base is just gonna grow. Your equipment is gonna be more and more subscription based. I think they were talking about that was said in on the IT review at the audit. There was hardware equipment that was gonna be purchased, but it's gonna be more and more subscription based.
That's how we operate. That's why SB put this out.
No other question. I'll open for public comment. Any public? Okay, with that, final comments, if not motion.
I think on this, the 5-year revisit is too long. I would prefer to see that at 3 years. That's one. The second thing is, I don't believe in spending a lot of money to do accounting per se. Having said that, I also believe our financial statements should adhere to GASB. And if there's a problem in the coming up with the numbers, I know I do a lot of work with AI and using tools, including, Claude and Gemini and Microsoft's offering, and I compare across all those, and you can crank the numbers through real fast. You just need to put in the variables, and it'll do it. This is not rocket science. I know that if you haven't done it before, it becomes complex, but once you create it, it becomes a lot easier. Having said that, you don't want to spend $1 to account for a nickel, right? But so I would support this, especially given what we're going to be dealing with in terms of our losses, or going into our reserves, provided that we revisit it faster than 5 years.
Your motion.
Yeah, is there a motion?
Well, so I would put forth a motion to do with the recommendations as set forth on the slide. changing the 5 years to 3 years.
Is that part of the motion or I don't see the?
It was not, but I believe it is 5 years right now, so we can change it to 3 years if the committee.
That's the policy, that's when we would have to revisit
the
it.
policy.
Yeah,
We're actually
But
gonna
it-
review as I said, the materiality of anything that falls below on an annual basis, that's our plan. We bring that, this is to bring the whole policy down.
Okay, any second? Okay, second. And we have voice vote, please.
Yes, all in favor?
Aye.
Any opposed, abstained, that carries unanimously.
Okay, any committee or staff comments?
I'll just make a comment that I'm meeting the PG&E local rep on June 10th, Monica Faria.
Thank you. Any staff, sorry, go ahead.
we don't have future agenda items on here, but I think it would be good to discuss at our next meeting if we've got time. And our next it's August or September?
August.
It's August. Okay. That may be a lengthy meeting, is that correct?
We'll have the stub period budget,
So, yeah.
yeah, and the other thing, we will wanted to review insurance items, if it's
Right.
coverage,
Yeah.
we can do that.
Sort of a brief presentation for the ERM policy.
Oh, yeah. We have energy risk management policy that I referred to. We have some changes to that, we will plan to make that in August too.
Okay, I just wanted to have a little bit of an idea of what's going on in August. So, but I don't have any agenda items that will affect August. But if I do, I raise them through the chair or through,
Or you can send it.
Okay.
Send them to me and I'll write them, we'll coordinate with the chair.
Okay.
Needed.
Okay, with that, we will adjourn the meeting at 12:10.